Hey, what's up, dividend investors? I hope you're doing well today. Mikey Hu for Dividend Stocks Rock here. Welcome to the buy of the month. So each month, I am putting roughly $1,000 into a new stock to create a brand new dividend growth portfolio. Before I tell you which company I bought this month for April, I want to look back at how the portfolio is doing right now. So far I bought shares of Waste Connections and also Franco-Nevada. You can see the portfolio's value now is like 2,200 for a gain of like roughly 5%. Of course, I'm not putting exactly $1,000. I just bought like 4 or 5 shares of each to pretty much create that average. I have a projected income now of $18 for the year. Yeah, it's not much, but you have to start somewhere, right? One thing that I like though is I already got my first reward. So on March 27th, if you look at the income calendar at the bottom right, you can see that I received my first dividend from Franco-Nevada. So we're starting small, we're starting humble, but we are starting. And that's the whole point about investing, is not asking you so many questions and just get your plan in order and start investing. I got a lot of investors telling me in the last video, Mike, that doesn't make any sense. Franco-Nevada and Waste Connections are trading at an all-time high. Their valuation is crazy. What are you doing? Well, just a quick note on investing at an all-time high before we move on to the stock that I bought. Keep in mind that financial literature is telling you that investing at an all-time high is actually a good idea. JP Morgan conducted this study between 1988 until August of 2020 to see the difference between investing at any other day on the market or investing at an all-time high. Shocker, if you had picked the all-time high value every single time, you're making more money than any other day on the market. So long story short, when you invest in stocks at a relatively overvalued price, maybe it's just the point on the market. A quick note on that, in 2017, I received my pension plan from National Bank. It was a little bit more than $100,000. I decided to invest it all back then. Well, if you do a quick look into Google, you'll see that Nasdaq.com was saying that all signs were pointing towards a overvalued market in 2017. CNBC even said that a lot of analysts are thinking that we are in an overvalued market. Even Ray Dalio is saying, yeah, dangers are ahead. Probably it's better to wait in cash. And then you can go on with Barclay Financials, Motley Fool, stock charts, and a lot of like other websites telling you, again, you should not invest in the stock market in 2017. Well, ironically, when I started my portfolio, then I bought a lot of companies, not only trading at the highest point over the past 12 months, but sometimes over the past 2 years. Companies like Microsoft, Visa, BlackRock, Texas Instrument, Alimentation Couche-Tard. And even if you just were an index investor and you bought the SPY to track the S&P 500, you were still up more than 150% after that. So sometimes when you're thinking that the market is overvalued, it's probably just a point of reference and maybe there's a lot of growth going ahead. Again, you do you. I'm not providing financial advice. If you don't feel like it's not the right time to invest in the stock market, that's fine. I just want to share with you what I bought this month. So I went for a company that is already in my portfolio, but it's still not a huge position. So I thought, well, it's a good timing to add another $1,000 into Stantec, the ticker N.TO, trading also on the US market because they generate 50% of the revenue in the United States. It's an engineering firm covering everything from planning to design all the way down to construction and also decommissioning the infrastructure. So they do have 5 business segments. The first one is water. So they offer water treatment, resources. They take care also of like wastewater. The environmental services will help minimize environmental impact, optimizing building, power and dams, water, oil and gas industry, and also transportation. Then you have the infrastructure that is taking care of like roadways, land and development, railways as well, and of course bridges. Buildings, the biggest sector for Stantec in the building industry is actually healthcare. They also take care of like civil engineering, commercial, educational, and institutional buildings. Finally, energy and resources. They have a lot of clients in the renewable energy, but also in the mining industry, water, power and dams, and also oil and gas. So as you can see, they are spread across every single segment that an engineering firm can serve. In terms of like revenue diversification, one thing that is great about this one is not really affected by tariffs because they have offices in the United States. So it's roughly 25% Canada, 25% global, and then 50% US in terms of revenue for 2024. Probably going to continue like this going forward. Now, before I go with the bull and the bear case, let's take a look at the dividend triangle. As you know, I always focus on three fundamental metrics to conduct my analysis, which are the revenue, the earnings per share, and the dividend. For Stantec, the dividend triangle looks incredibly strong. So as you can see, the revenue is going up, the earnings going up, and that leads to a constant dividend increase of like between 7 to 8% pretty much every single year. So it's been more than a decade that the company is offering a high single-digit dividend growth, mostly because it's able to grow their sales and also grow their earnings. So now how they can make that happen. So let's take a look at my bull case for this one. The first thing is cross-selling opportunities. So the company has multiple segments, multiple clients, and they are able to offer a lot of services to those clients. In fact, half of the top 25 clients are actually using 4 or 5 business units. So you have a lot of potential to grow there, and it incurs also a great diversification. The second thing is the company has a very strong backlog. So if you are worried about the potential recession, well, you'll be happy to see that Stantec has a backlog that is fueled by both organic and also growth by acquisition. Speaking of growth by acquisition, this is one thing that I really like about Stantec is that they are able to generate growth on both sides. So as you can see on this chart, you have double-digit organic growth from the water and the building business segment, but you also have double-digit growth by acquisition coming for the infrastructure and the building business units as well. This is often something that we see when we have a firm that is growing by acquisition is the organic growth is close to zero sometimes, and their only way to increase their revenue and earnings is to by acquiring other companies. In this case, they are actually doing it both ways. Of course, no companies are perfect, and Stantec also has a bear case. The two most important danger for Stantec, the first one is actually competition. If you look at WSP Global, for example, another engineering firm, the company shows more than double its market capitalization and more than double its revenue per year. In other words, WSP Global has probably better chances to get huge contract, to attract talent, and to maintain their margin, as Stantec will have to act as a challenger, trying to retain their talent, maybe bid a little bit a lower price for new projects to win them, and that could hurt their margin going forward. The second problem is, of course, the engineering industry is quite cyclical. If you look at Stantec revenue over the past 10 years, you will see that there was a drop down in 2018 and another drop down in 2021. So it's not a smooth moment. Now that we are expecting a recession in 2025, maybe 2026, there are a lot of dark clouds around. Maybe we're going to see another slowdown for the revenue, but I still believe it's the right time to invest in Stantec because I'm not thinking about the next 3 months, I'm thinking about the next 30, 40 years. As I said in my introduction, my goal with this portfolio is to build a long list of strong dividend growers. So I focus on companies with robust financial metrics that will probably show a profile of like low yield, high growth stocks. And I did not want necessarily to add companies that are not in my portfolio already. So that's why I decided to add more of Stantec, a company that I already know, but it was not big enough to my taste in my overall portfolio. So, all right, guys, that's enough for today. I hope that you have enjoyed this video. Let me know what is on your buy list right now in the comment section. Do not forget to give me a thumbs up and to subscribe to the channel to not miss the next video next Thursday. And until the next time, don't forget to stay invested.